If you're over the age of 50 and you're making pretty good money, there's an important rule coming in 2026 that could directly affect how much you're allowed to save and how you're allowed to save it. Today, we're breaking down who is considered a high wage earner under this rule, what that actually means, and why some people will be forced into Roth contributions while others may lose catch-up contributions altogether. My name is Spencer Ford. I am CEO and wealth advisor with Conservative Financial Solutions. I'm also a certified financial planner professional, and let's get into today's video. This rule comes from the Secure Act 2.0. Congress wanted higher earners to pay taxes now on catch-up contributions instead of deferring those taxes into retirement. So starting in 2026, certain people are no longer allowed to make pre-tax catch-up contributions. Instead, those catch-up contributions must go into a Roth account, or you may not be able to make those contributions at all. So first, let's level set. A catch-up contribution is any amount that you contribute above the normal 401k limit or 403b or 457 plan once you turn age 50. In 2026, the standard 401k contribution limit is $24,500. If you're age 50 or older, anything you contribute above that amount is considered a catch-up contribution. The maximum catch-up contribution is $8,000, meaning you could potentially contribute a total of $32,500 to your 401k. This rule only applies to the extra portion. Your regular 401k contributions aren't affected. There is an additional catch-up contribution rule for those age 60, 61, 62, and 63. Your catch-up contribution limit is actually $11,250, bringing your total contribution limit to $35,750. Now, you must be the age at the end of the year for you to qualify for that. So if you turn age 64 this year, you'll be eligible for the regular catch-up contribution, which is $8,000, but you will actually not be eligible for the $11,250 contribution. Just so you know, those rules exist. Here's the key definition for a high wage earner under this rule, and this is where most of the confusion comes in. You are considered a high wage earner if all of the following are true. You are age 50 and older, because that's when you're allowed to make up catch-up contributions. You're making those catch-up contributions. Your prior year wages are over $140,000. And those wages are measured using box 3 on your W-2, your FICA wages. And the income is from the same employer. That $145,000, so it's $145,000, I said 140 before, is also indexed for inflation. So it may be slightly different by the time we get to the end of 2026. But for right now, it's $145,000 and the structure stays the same. This next part is critical. Like I mentioned, the IRS looks at box 3 on your W-2, not box 1. Box 3 represents wages subject to Social Security tax. That means bonuses, deferrals, and benefit elections can make box 1 and box 3 very different numbers. And this is based on last year wages, so your 2025 W-2 determines whether this rule applies to you in 2026. So, a few things that do not matter for this rule. Your spouse's income doesn't matter for this rule. It's looked at on an individual basis. Your household income, your IRA contributions, your investment income, your self-employment income, and wages from a different employer don't count towards this rule. This test is strictly employer by employer. Let's look at an example. You're 57 years old. In 2025, your box 3 wages are $162,000. In 2026, you want to make catch-up contributions, but you're a high wage earner under this rule. The result is simple. All catch-up contributions must go to the Roth. There is no pre-tax option for those catch-up dollars because, again, Congress wants you to pay taxes on those catch-up contributions. They don't want you to defer those taxes. Now, another example. You're 61 years old. Your 2025 Box 3 wages are $138,000. Even though you're over age 50, you are not a high wage earner under this rule. This result is that you can still choose to put your catch-up contributions towards the pre-tax portion. Now, you can certainly still put them towards the Roth portion, but you can still use that catch-up contribution and have it be pre-tax if you wanted to. Now, the next example catches some people off guard. Let's say you're working for the same employer in 2025. Your Box 3 wages are $150,000. In 2026, you reduce your hours, or maybe you step into a different role, or you're just projected to earn less money, so you're going to be projected to earn $120,000 in 2026. Even though your income went down, the IRS still looks at your wages for 2025, so the result is that you are still considered a high wage earner for all of 2026, and your catch-up contributions must still be Roth. This rule has a 1-year lag. A pay cut does not immediately restore pre-tax catch-ups. So if you go from full-time to part-time and your income is reduced, you're still going to be considered a high wage earner for that year. Now, let's look at a job change example. In 2025, let's say you made $200,000 at employer A. In 2026, you changed jobs, and now you're going to make $120,000 at employer B. Employer B only looks at what they paid you. The result is that you are not considered a high wage earner at the new job. You may once again make pre-tax catch-up contributions. And one more important detail for those approaching retirement. Again, just to reiterate something in 2026, individuals ages 60, 61, 62, and 63 may qualify for a higher catch-up contribution, often called a super catch-up, if their plan allows for it. The standard catch-up contribution for age 50 and over is $8,000. The special catch-up for ages 60, 61, 62, and 63 is $11,250. That means someone aged 60 to 63 could contribute up to $35,750 total in 2026. That's $24,500 plus the higher catch-up. But if you are a high wage earner, that entire catch-up portion must still be Roth. Here's the harsh part of this rule. If you're a high wage earner and your employer does not offer a Roth 401k option, you cannot make catch-up contributions at all. They can't be pre-taxed. They can't be reclassified. They can't go to an IRA. No Roth option means no catch-ups. There is one important exception. If you are self-employed and you're using a solo 401k, this rule does not apply to you. You can still make pre-tax catch-up contributions even if your income is high. Here's what you should do now. Check box 3 on your W-2. Confirm whether your plan has a Roth option, and understand the 1-year look-back rule. So coordinate your Roth strategy before 2026 and look at alternative tax strategies if catch-ups are lost. This rule doesn't affect everyone, but it affects you. But if it affects you, it can change your retirement strategy in a meaningful way. If you found this video helpful, please hit subscribe. Again, my name is Spencer Ford, and we'll see you in the next one.